just a few slides to check out while everyone is getting settled. You're not missing anything if you're still just coming into the meeting. I would recommend that you grab something to drink and a pen and paper to take some notes, because we are going to cover a lot of material tonight, and it's like drinking from a fire hose. So you might want to jot down some notes. And then as well, if you have questions that come up, I'm going to recommend that you jot those down, and we'll be able to address them toward the end. In the meantime, let me go ahead and share my screen. Okay, now I'm sharing the screen, and hopefully y'all can see it and hear me. Just so that you know, this presentation is being monitored by a colleague at the Society. So if you have technical issues or questions, you can pose those questions, and Grace will address those for you. Hopefully you can hear okay and see okay. Again, the first few minutes, these are just some informational slides. We haven't really started yet, so give yourself a minute to get settled and grab something to take notes with, grab a drink of water if you need one, or something stronger. We are talking about paying for college after all. But just make yourself at home. We expect to be about an hour in this presentation this evening. If we go a little bit over, I hope that's okay. But I will try to move through the information at a quick pace so that we get everything covered. I will introduce myself momentarily. We'll just give you a few minutes to get everybody into the meeting and get comfortable. So if you're just coming into the meeting, don't worry, you haven't missed anything yet. We've just got some, teaser trailer type slides coming in for you as everyone gets settled. We'll get started here just in another minute or two. If you didn't hear me say this before, please get something to take notes with. We're going to cover a lot of material, and you may want to jot down some notes. Also, if you have questions, I'm not able to see the chat while I'm giving the presentation, but it is being moderated by my colleague at the Society of High School Scholars. So if you have questions, please, I'll address them at the end. You can post them, and Grace will let me know at the end, and I can cover anything we didn't cover or anything that you need clarification on. We will cover toward the end. Okay, so let's see. It's about 4 minutes past the hour. We'll get started probably at 5 minutes after the hour. Okay. Hopefully you can't hear my air conditioning cycling on in the background. I'm talking to you from lovely Los Angeles, California, where it's a really, really warm day. Hopefully that's not distracting. Okay, I think we're good to go. So my name is Cindy Menegaz. I'm the National Program Director at SMARTTRACK College Funding. I'm very, very pleased to be able to address you this evening. Again, this presentation should last about an hour, and if you can stay for the whole thing, that would be ideal. We are going to cover questions at the end. If you have them, you can put them in the chat. There's also a quick poll we will give at the very end of the presentation. If you could stick around and take that, it would be very helpful both for the Society and of course for us. We really appreciate the feedback. So a couple words about me. I happen to be a mom of identical twin boys who just graduated college 3 weeks ago, in the middle of May. And you know what I'm most proud of? I'm certainly proud of them, but the fact that they're debt free goes a really long way. That's a huge accomplishment. And I want you to know that I came to this company and this whole subject um, naturally, in that when my kids were in ninth or 10th grade, I think they were just entering 10th grade, I came to a college funding workshop when my husband and I realized, oh my goodness, we don't know how we're going to pay for these two boys. They have big aspirations, and we just don't have nearly enough money saved. What are we going to do? And that's where we really learned about the subject I'm going to talk to you about this evening. And it was so life altering for us. The level of stress in our household just went, and I was able to sleep well at night, knowing that whatever happened, we were going to be in decent shape. It made a huge difference, and I ended up asking the head of the company, I think you should hire me because this really makes a lot of sense. So I made a left turn in my professional life, and here I am. So I'm delighted to be sharing this information with you. And let's get started. So SMARTTRACK is a national company. We've been around for many, many years. We have a team of professional licensed college funding experts backed by a platform of software tools and resources to support them and our clients and folks who take advantage of them. There's been 250,000 families across the country who we've been able to help better pay for college. And we really see ourselves as turning the college funding business landscape on its head, in that you can go in any market across the country and hire a professional college funding planner. They will typically charge in the several thousands of dollars. What we've been able to do through our team of advisors and the software and the relationships that we've built is really make this information accessible, make advanced services affordable for those who even need them, really level the playing field. And we're very proud of that and glad that we can be here to assist society families. What we do is team up with membership organizations like the National Society of High School Scholars, but as well as businesses and organizations, independent college admissions counselors, and high schools of every variety across the country. And our purpose is to really help educate families on what their role in the college funding process is. So too often, you see families just really passive in the process. They are instructed just to submit a financial aid form when the time comes and cross their fingers and hope for the best. And there's really a lot more you can do to be proactive in this process. And we'll talk about that tonight. What we do is provide live professional support and software resources to help in that as well. You all have access to our platform, and there's a lot of free resources on that platform. I'm not going to go through them and give you a tour of them this evening just because we don't have enough time, and they're really self-explanatory, but I will show you how to access them, and that way you can spend your own time, as much time as you'd like, exploring those resources. And then for folks whose situation even warrants it, if you have a complex situation and you need some professional help developing a plan, we can certainly help you with that. And we offer steeply discounted services for society families. I will touch on what those services are toward the end of the presentation. Just, I don't want to leave you hanging. I want you to know what is available to you. But whether you work with us or somebody else or do it on your own, it's entirely up to you. But I want you to know what's available to you. So what we have found over the years working with umpteen families is that no matter what your situation, families have the same three concerns. They want to know, how do we pay for college? How do we use our income and our assets to cover the costs and pay less, right? That's the second thing. How do we pay for it, and how do we pay less for it? How do we shave tens of thousands of dollars off the cost of educating our children? And how do we balance these two sometimes competing goals of educating our children and also knowing that we're going to want to retire one day and not be a burden to those same kids? So if you have one or more of these concerns yourself, if you're sort of shaking your head going, yeah, that's me, you're in the right place. Thank you for being here. So the screen I'm going to show you next, I titled this presentation um, what middle income or upper middle income families need to know to pay less for college. And the reason I'm focusing on middle income and upper middle income folks, and by that I'm showing you this screen. If you fall into any of these ranges, one or more of these buckets, this is really kind of what I'm talking about here. And the reason is that typically folks who fall in this category assume that they're not going to qualify for much financial aid, but they can't afford to pay full price for college either. And so they get really squeezed and they end up underfunded and overextended and dependent on expensive loans. That's really why we try to focus on that. That's not to say that families who are on either end of the spectrum, whether it's low income or very, very affluent, that the stuff we're going to share tonight won't be applicable to you. Much of it will be, some of it may not be. So I just want to preface that's kind of where our focus is. So the reality is that where your student ends up attending school will possibly have a lot to do with the cost. The fact of the matter is that middle income and upper middle income families will overpay for college by an average of $22,000 per year per student. That is a lot of money for any person, right? For any family, regardless of your circumstances. That's a lot of money. And the reasons this happens are several. One, they assume that they're not going to qualify for financial aid, so they don't bother applying. Again, these are folks who figure, hey, you know what, we have a nice income or a modest income. Maybe we own a home or have a business or something. And, we're not the folks that we think of as really needing need-based financial aid, so we don't apply. That's one problem. The second is, well, maybe you submit a financial aid application, but you don't plan in advance. You don't organize your finances so that you're assessed in the most beneficial way possible. The best analogy I can give you is if you were to submit your tax return without taking all of the legitimate deductions that you had coming to you, obviously you're going to pay more for college than you might otherwise, right? The same is true for applying for college and financial aid. Another reason that families pay more than they have to for college is that they don't apply to schools likely to be generous in terms of aid with their student. So, very often we'll see families who say, look, Junior, you can't apply to these schools over here. The price tag is ridiculous. We're not affording that. We can't pay for that. Don't even look at them. Stick close to home or an in-state public school. They're more affordable. The reality is that if it's a well-matched school um, and they have money to give, it's a generous school historically, that can be a huge source of financial aid and merit aid. And we'll define those terms as we get into this. But that's a real important reason for why families pay more than they might otherwise. Another reason, even if you have a great plan, you've organized your finances and you're applying to schools that are likely to be generous, but if you make errors on the financial aid applications that are required of you come your student senior year, that's a reason for the government and the schools themselves not to give you everything that you might otherwise be eligible for. And so we see this a lot. You don't want to make mistakes when you're going to submit your financial aid forms. And then lastly, this might not be as obvious, but people pay for college in really inefficient ways, meaning how you pay for college will impact how much you pay for college. This is really an important concept because if you're using your funds in an inefficient way, it's going to cost you money down the road. I'll give you some examples of that as we go through. So it would make sense then to distill that conversation down. If there are three important takeaways, three things that are really important to make sure that you don't pay more than you have to for college. The first is to make a plan for how to pay for college that's going to put you in the best light possible when it comes to being assessed for financial aid, even if you don't think that you're going to qualify for it. And secondly, to determine the best strategy for how to use your own resources in the most efficient, tax advantaged, cost efficient way, right? That's what we call paying smart. So when you pay smart, when you're looking at schools that are likely to provide gift aid for your child, and when you're getting your forms submitted correctly and on time or even early, those three things are going to help defray your costs significantly. So those are really the important takeaways. And I think that's true regardless of where you fall. Um, Okay, so the number one reason that students don't end up attending the great fit schools that accept them is that it costs too much, right? Family finances. So when you plan ahead, one of the reasons why I push this so hard, why it's so important to make a plan in advance, is that it helps you maximize how much aid you're eligible for, both merit-based and need-based. And I will define those terms as we go through this evening. And it helps reduce how much money you have to borrow. If you're using your own money in the smartest way possible and you're maximizing how much money you're gifted, that means there's less money that you have as a gap that you actually have to borrow. And that's great because it's really expensive. And then every family is going to have a unique strategy for how they're going to tackle college costs. And the reason I can't just give you, I mean, I get asked this question a lot, Cindy, can't you just tell me the best ways to save for college and how we should fund it and what are things that I really should do right now? These are things that I can't say in good conscience because what might be really beneficial to me and in my financial profile might actually damage yours or someone else's. So we have to be very careful about not giving you a specific plan of action because it could in fact hurt you, and we don't want to hurt anyone, obviously, but it's important to understand what your specific details are so that you can make a plan that makes sense for your family. The ultimate goal is to understand what your options are so that you can make educated decisions about the health and financial well-being of your family. Okay, so let's shift gears here for a second. I want to define cost of attendance. So oftentimes you'll hear the word tuition when it comes to how much a college or university costs, right? So tuition is just one piece of cost of attendance. COA is the total amount that it's going to cost per year to send your child to a particular college. It includes the tuition, but also fees. They all have fees. And if your child lives in a dorm or lives off campus, their housing, if they have a meal plan, they got to eat, right? Books, expenses, transportation, all of that is considered cost of attendance. And as you start researching schools, be really careful not to compare tuition at one school and cost of attendance at another because you'll be comparing apples and oranges. Tonight, we'll be talking about cost of attendance, so it's all in. So just to give you some examples of what things cost, an in-state public university, each state has a university system, and that public school will be more affordable for families who live in that state. So let's say your child wants to go to UNC in Chapel Hill, and you do live in North Carolina. You would be looking at a cost of attendance to live on campus of nearly $25,000 a year. But let's say your child wants to go to UNC and you don't live in North Carolina, you live in another state. You'd be looking at paying out of state tuition, out of state costs. So your costs jump to almost $53,000 a year for that same year of education at UNC. So those are public schools, whether you're in state or out of state. And then you have the private college system, right? So there are private schools all over the country. It doesn't matter whether you live in the state that it's in or not. They all have the same cost of attendance. At Tulane, for example, to live on campus for a year of Tulane, it's going to cost nearly $76,000. That's per year, right? So, oh my gosh, that's insane, right? It's so expensive, no matter where you go. In-state public schools range anywhere from $20,000 to the high 30s, 37, maybe 38, depending on where you are. Out-of-state public schools can run anywhere from around 40,000 to as much as 65,000. And private universities run into the mid-fives to as much as $8,000 per year, which is crazy, right? So, you're going to find some that are more expensive, some that are less, but these are pretty good ranges. So you figure that 4 years of college to get an undergraduate degree can run you anywhere from $80,000 to as much as $300,000. Now, of course, these are full retail prices, and hopefully we're not going to pay full retail. That's the point, right? But how much, have you saved? That's a good question. The majority of American families have saved enough to send their child to college for one semester. So it's a sad state of affairs that makes it very difficult for families who are in this situation. But let's say that you've been trying to put some money aside, and let's say, oh my gosh, you've saved $100,000 per student. That's fantastic. How does that set you up? So depending on where you're looking, if you're looking at an in-state school, you average $100,000 for that 4-year education. Hey, you've got just enough to get you there without having a gap. If it takes longer for your student to get that undergraduate degree, sometimes it takes 5 years or 6 years, right? You have to plan that that's going to add to your total expense load. If you're looking at an out-of-state public university, maybe that education's going to run about $200,000. Now you have a gap. Maybe you're $100,000 shy of being fully funded, or maybe more, again, if it takes longer to get that degree. Private universities, again, that undergraduate degree might run $300,000, and you could be shy a couple $100,000 to get that, at least to fully fund it, right? And again, if you have more than one student, what does that do, right? So that begs the next question: how is a family supposed to pay for this, right? It's incredibly expensive. Well, the first thing we typically think of when you talk about paying for college is, well, how much money do you make? It's going to come out of your income. Income and savings, what you've got set aside. Occasionally we see families who come in and say, hey, you know what? We have a healthy income and we can afford $5,000, $6,000 right off the top, right out of income per month to pay for college costs. We haven't necessarily saved a lot of money, but we can afford to just bankroll it. Here's the issue. Unfortunately, the current times that we're in illustrates my point all too well, and that is things change. Our jobs are not guaranteed. Our financial situation isn't guaranteed. We might lose our jobs or get laid off or see our incomes take a hit. We might have to take care of ailing parents. There are a lot of different things that can happen. And again, typically you're paying for college over a period of years that your child is in school, or children if you have more. So any number of things can happen during that time. The reason I bring this up is just that it's important to have a plan B in terms of how you're going to pay. Savings, of course, means whatever savings instruments you might have, wherever you've got your financial assets stored, whether it's a savings or checking or mutual fund or CDs, etc. Borrowing money, that's the second thing I want to talk about. So there are several different ways that folks might borrow money to pay for college. Let's talk about loans. That's the most obvious one. So I wonder if you know how much a student can borrow from the government to pay for college. There's a student loan program run by the government, but guess what? A student can only borrow $5,500 their first year, $6,500 their second year, and $7,500 after that. So is that going to buy a lot of college based on how expensive it is? Yeah, not so much, right? So, the government isn't going to allow your student to get in so far over their heads that that they can't really afford it. Well, they might not be able to afford it, but they're not going to let them borrow even more than this. There are two types of federal student loans. One is considered subsidized, and that's where the student does not have to pay interest on that loan until after they're finished with their college education, or unsubsidized, where you have to start paying interest right away. The government sets the interest rates right now. That's at just over 4.5%. But as of July 1st for the next year, they're actually bringing those rates down considerably. So the student loan is really the best option that one has. It's the first choice to maximize what's available there, because that has the best interest rates and the best terms for students. I'll tell you why she's crying. So if your student can only borrow, you know, $5, $6, $7,000 a year to go to college, where's the rest going to come from? Well, not a big surprise. The federal government will loan parents money to pay for their college students' education. They're called parent direct loans, and this is how they work. So for every $1,000 you borrow, at least right now, they're running about $12 to $15 per thousand, and these are 10-year loans. The interest rate right now at the year that's ending July 1st, the current interest rate is just over 7%, but it can have a range of even more than that. Again, these rates are coming down for the period July 1st for the following year. So if you have a student that is going into college in 2020, this fall, you're going to have much better rates, and that's a good thing for you. The government also includes a 4.24 origination fee on their loans. If you purchased or refinanced a home recently, did you pay 4 points on your loan? No, you didn't. If you did, your lender would be in prison for predatory lending. And yet, the government adds a really hefty origination fee to these loans, which can be very expensive. There might be some tax benefits. It just depends on the parental situation. So that's something to consider. Let me give you an example of how this works. So let's say that your child wants to attend a school and the cost of attendance is $70,000. They get accepted, they want to go. They get a financial aid package which provides free money, grants and scholarships to the tune of $30,000. Fantastic, shaved right off the top. You still have to come up with 40 grand. So how are you going to do that? So let's say after looking at your finances, you determine that you can pay $20,000 a year. That would be $1,666 times 12. That's how much per month you would cover. But you still need $20,000 to, help your kid get to their dream school, right? So if you figure $20,000 times $12.50, right, about $12 per thousand, you're looking at a payment of $250 a month. Hey, for $250 a month, my kid gets to go to their dream school. Let's do this. Okay, so let's see what this looks like. All right, so you've already said that $20,000 you're being able to pay for. That's that $1,666 out of your pocket, and $250 a month for the loan. Now, your child finished their first year. Do they have their degree? No, not yet, right? So they're going to have to go back for a second year. So let's assume in their sophomore year that the cost of attendance didn't go up, that the aid package your child received is the same, and that your financial situation is the same. You still need to borrow $20,000. So now you go in for year two. Now you're paying $500 a month on these 10-year loans. And you can see where I'm going with this, right? So now you're in your third year of college, your child's in their fourth year of college, and now you're paying $1,000 a month on top of the $1,666 that you needed to cover out of your pocket. Now remember, these are 10-year loans. So here you are in year 5, 6, 7, 8, 9, 10. By the time you're 14 years out and you've paid these loans off, this has become a very expensive prospect. And again, if you have more than one child and they start college around the same time, now maybe you've doubled that, right? So this can be a very expensive option. And the reason I bring this up to you is because we see too often where families wait until the last minute and they're backed into a corner and their only option is to take these expensive loans. And they don't really realize just how they're going to add up and become problematic. So what I really want the takeaway here to be is that you need to take advantage of every opportunity to use your own finances in the smartest way possible to minimize your gap so you have less money to borrow. It's really important. The other thing I'll mention about loans is that I've shown you the federal loans, but there are also private loans. Typically, if you have really good credit, really solid credit, you're a good qualified borrower, the private loans might actually be less expensive than the federal program. Right now, for the next year, given the pandemic, the government has lowered rates. So right now, the federal loans are looking pretty good. But if you've got a student who still has another year of high school or 2 years of high school and you're a couple years out from college, you'll see what the loan rates are going to be when the time comes. But private loans are also in the mix here, and they can potentially be better or worse. You need to check out your options when the time comes. Okay, we talked about borrowing from the bank or from loans. What about retirement accounts? Are those a good idea to take money from to pay for college? I can't see your answers, but I'm wondering if you're shouting out, well, if you borrow money from your retirement, then you might be expected to pay taxes and fees for taking money out of your retirement account. That's one big reason why that can be an expensive prospect. Another is that when you drain your retirement accounts to pay for college, then you wake up with a retirement problem. It's funny that the banks will loan you money to put your kids through college, but they won't really let you borrow money for your own retirement, right? Another issue with retirement is that when you take money out of your retirement accounts and you go back the next year to reapply for financial aid while your child is still in college, the schools look down upon it. They see that revenue that you took from your retirement account as income. And that additional income can limit how much aid you're eligible for the next year. So it can actually reduce how much free money you get. So it can be a complicated proposal. Retirement accounts, they're kind of dicey for several reasons, right? Another place you can borrow is if you have equity in your home, if you own a home, if you own rental properties, if you have a vacation place that you own and you have equity in that. Those are other potential sources of funds for you to pay for college. Now, how you access those and whether you do and in what amounts, again, are all going to be dependent on your specific situation. I can't tell you categorically whether or not that's a good idea. It all depends on your situation. Okay, so private scholarships is another way to come up with money for college, right? Private scholarships, they get a lot of attention and unfortunately don't have as much bang for the buck as you might hope, given how much attention they get. So private scholarships actually only make up 4% of the total financial aid that's out there available to you each year. And they typically, anyway, are made up of what we call small denominations. So maybe it's, $250 or $500 or $1,000 or $2,500. That's great. And it adds up and all of it helps defray your costs. But the downside is that it will oftentimes take your student a lot of time and energy to apply to a lot of different scholarships. They're really chasing kind of low denomination. So if your student's really on the game and doing well in school and has the time and the energy to devote to this, great. It's just going to add to your total pot. One thing I will caution you though, and this is something you might want to write down for when the time comes, when your student is applying to college and has a university in mind, you want to call their financial aid office and find out what their stacking policy is. So a stacking policy is when your child has worked really hard and she's come up with, say, $5,000 worth of private scholarship money for college. And the school has said, hey, we're going to give you $20,000 in grants and scholarships. And you say, great. And then they see you've got $5,000 in private scholarships. And they say, well, that's $5,000 that you don't need anymore. So we'll just scale back our gift to you and give you $15,000. What? Are you kidding me? After all that hard work? So that is an instance where that can be kind of dicey. And it's a red flag. I just want you to be aware of it, that some schools, certainly not all of them, may have a policy like that. You just want to know ahead of time so you're not disappointed. Another way to lower your costs, right? Choose a less expensive school. The conversation I'm meaning to have about this is about community college. So community college, typically, what I'm going to say right now is our typical feeling about community college, but I'm going to have a caveat at the end of it. What we typically say is that Community college is for the community, right? If you have a high school student who is really motivated and really accomplished and done really well in high school and is prepared emotionally and intellectually and academically for the rigors of a 4-year university, then a community college might not be the best fit for that student. And even if it's really affordable, fit is important. And there might be other universities out there that could be a great fit, that could be really generous with your student, and that could be more affordable than you think. If, however, you have a student who in high school hasn't quite got their act together, hasn't quite figured out kind of what direction they're going in, their grades aren't quite there yet, or maybe, they're not ready emotionally to leave home. Maybe it doesn't make sense to spend all that money on a 4-year university for a kid who needs to be at home for a couple more years and really develop and mature before they transfer or leave home. So in that instance, a community college might be a really good option. The caution I have for you is that you want to make sure that your student is motivated and really tries to go for their AA, which is the degree you get from a community college, because they need that in order to successfully transfer to a 4-year college down the road if they want to. I've seen so many disillusioned students who take some classes at community college, and then when they transfer, they find that those credits don't transfer and they have to start over again. And it's very frustrating. And I don't want to see your students have that problem. So make sure that where you want to go to, that the classes you're taking will transfer. The reason I said there's a caveat is that the elephant in the room is that we're in the middle of a pandemic and things have changed for not only all of our families and our own situations, but for the colleges as well. Whether the students are going to go back into the classroom in the fall, whether the colleges are going to have as much money as they had in their endowments, if they took a financial hit. There are a lot of things that kind of change the normal, right? We have to be nimble and deal with the realities in front of us. So if your child is looking at attending college in the fall, hey, you know what? Even for a great student, maybe it makes sense to stay at home. Maybe it makes sense to save that money, especially if money's really tight right now, given the pandemic. Just make sure, again, that you're in a good position to transfer when the time comes. Okay, let's move on. Financial aid. There are two different kinds. There's gift aid, which is what we love because it's free money. That's money you don't have to pay back. That includes things like grants and scholarships. Sometimes the words are used interchangeably, but it means money that's gifted to you that you don't have to pay back. Sometimes universities have other ways of helping lower your costs with, housing allowances and the like. There are other types of gifts that they might have in their arsenal. Merit aid is an important concept if you're not familiar with it. Merit money is scholarships that colleges and universities can provide your child based on your kids' successes. Things like their academic success or their leadership skills, or if they're an athlete and they're looking to play sports, maybe they're on an athletic scholarship. Maybe if they're an artist and they're looking at attending an art school, that their portfolio could bring them merit money. There are a lot of different reasons why a school might give your child merit aid, and we love merit because they give it to you based on your child's profile and not on your financials. So that's really great. You want to get as much merit money as you can. The other type of financial aid is what they call self-help. That includes work study. Work study is where, as part of your financial aid package that your student will get when they get accepted to a university, it might include the option for them to have a job on campus where the wages are paid by the federal government. That's a work study program. It doesn't mean that if you don't get work study in your package that your child can't get a job on campus or in the community where they're going to school to help make ends meet and to get some extra pocket money. And then loans, of course, we talked about the federal loans. The bummer is that the government will put a big package of loans in your financial aid award package and see it as financial aid. Personally, I don't see a loan offer as financial aid. That's not the kind of aid that we're looking for. So what kind of aid are we talking about here? Well, there's $184 billion of it every year available, and we want to make sure that you get all of it that you're eligible for legitimately and fairly, right? It comes from state and federal governments. It comes from those private universities that have endowments, that have money to give, and it comes from private organizations in the way of private scholarships that we talked about. So remember we said that private scholarships really only make up about 4% of the total. When you add that to employer grants, you see that there's in this green section here about $12 billion out of the total. So not a ton. The low-hanging fruit, the bucket that we're really interested in here, is the institutional grants. This is the $49 billion that come from those universities themselves who have money to give, who want to incentivize your child to come to their campus. So that's the real money that is going to help us send our kids to school more affordably. The other areas where money is coming from, state grants make up a small piece of this. There's about 41 billion that come from the government. Federal grants like the Pell Grant help low-income students get the money they need to attend college. That's where work study comes from. There are veterans benefits that come out of this pool. Then you have education tax benefits make up about $15 billion of it. Again, that typically is lower income families who can qualify for that. And then you've got the federal loans. That's the biggest piece. Again, that's where you get a piece of your award package that says, oh, hey, we're going to help you pay for college by offering you a package of loans. So we hope that that's the smallest part of your package. Okay, so let's talk about some myths. We're never going to get financial aid because why? I can hear it. I can hear it through cyberspace. You're saying, because we make too much money, our income's high, they're not going to give us financial aid. That's a really important myth that I want to dispel. We work with families that some really need it because they really do have low incomes, and some really need it because even though they have a nice income, maybe it's 150 or 200 or $250,000 in income. That seems like a lot. They're not going to get any financial aid. But you know what? Depending on where you live and what your other financial circumstances are, you may actually qualify for things that you might not have anticipated. Another reason, I don't have a 4.0 kid. Their grades aren't high enough for us to get financial aid. You know what? Not every school is looking for a 4.0 student, right? There are great match schools out there for every student, and those schools want to incentivize your child to attend their campus. So when you find a great match school for your child, chances are that if it's a generous one, financial aid is in your future. Some families think, well, we're not going to get financial aid because we own our home, or maybe we have a business, or maybe we have some assets. You know what? They expect you to have some things. They expect that some people are going to own a home or have a business or have some assets. That doesn't necessarily keep you from getting financial aid. Again, depending on how all of these things are configured, might impact how much aid you're eligible for. The idea that your minority status plays a part of your financial aid awards, it just doesn't happen, except for those private scholarships we talked about. Some of those are geared for particular demographic groups. So in that sense, private scholarships might be dependent on your status. The idea that your child could become independent and therefore you don't have to apply for financial aid and your student can get more aid as an independent. We hear this sometimes that, oh, well, let's just do that. It's a lot more difficult than you might imagine. If it were easy, everyone would do it. It's really just not legitimate unless they're looking for things like, if your student is married or has a baby themselves, if the parents are deceased or in prison, if the child is on active duty, if what's another one? If they're homeless, that's a reason why they might get emancipation from the courts. And it's not so easy to get emancipated. You actually have to have a court order. So becoming independent is not so simple. And just because the parent doesn't include the child on their tax returns as a dependent, that's not a reason that they'll accept your child as an independent, emancipated person. So yeah, that's a myth. The idea that the college can help you, that the financial aid office is there to help you. Unfortunately, they are not there to help you make sure that you get every dime that you deserve. Their primary job is making sure to take into account the university's endowment, right? How little can they give you to still get you to come to their campus? And you're trying to figure out how much can you get in order to say yes, right? The best analogy I can give you is, you wouldn't expect the IRS to call you and say, hey, you know what, you missed a deduction on your taxes. The college isn't going to do that. You have to be your own best advocate. And you really need to be looking at this stuff long before your child ever applies to college and you encounter a financial aid officer at a university. Okay, so here are some things to write down. FAFSA. FAFSA is the free application for federal student aid. This is the financial aid application that the government uses to determine how much aid they're going to offer you. They use what's called your prior year to assess you. In other words, if your student is graduating high school in 2022, then the financial decisions that you made that show up on your tax return for 2020, those are the ones that they're going to look at. They're going to be looking at your 2020 tax return when they evaluate you for your student that graduates in 2022. That's prior year. That's why it's so important to start this process as early as possible, so that the financial decisions you make now don't end up hurting you later. You want them to help you later. The FAFSA is submitted. It opens October 1st of your child's senior year. So don't worry about this. It doesn't open until October 1st of your student's senior year. You have to reapply every year that your child's in college. They want you to resubmit the FAFSA. The most important thing I can tell you about it is that you need to submit one and you need to submit it correctly. This is one area where, it's great when students take the lead role and really take ownership of their college planning and college application process. I don't know that I want my 17 or 18-year-old to deal with my finances and to deal with the FAFSA. It's hugely important. It can mean the difference between a lot of money. And so you just want to make sure it's done correctly. So do it with them if you need them to be involved in it. Okay. The next thing I want to talk about is the CSS profile. This is the financial aid application that many, not all, but many private universities and private scholarship organizations ask you to submit a financial aid application called the CSS profile. This takes a much deeper dive into your finances than the FAFSA does. The FAFSA is fairly straightforward, not a ton of questions. It's fairly doable. The CSS profile is more complicated. They also look at your prior year, but also the year before. So they look at 2 years worth of your taxes. And it's not free. They charge $25 and then $16 for each additional school. So when your child is developing their list of where they want to apply, you will look it up and see if the schools on your child's list require a CSS profile or some other financial aid form in addition to a FAFSA. And you want to make sure that as soon as that application season opens in October of your child's senior year, that you download it and you start working on it. Don't wait until the last minute because it's complicated and you just can't wait until the last minute to do it. Here's the thing. The takeaway is if the school your child's applying to asks for a CSS profile, do it as accurately as you can because it will be the key that can unlock tens of thousands of dollars of financial aid for you. Okay, EFC. This is perhaps the most important thing I'm going to talk about right now. This is your expected family contribution. What this is it's the minimum amount that the colleges and universities think that you can afford to pay per college year per student. And you might ask, how are they supposed to know how much I can afford for college? Well, by the time you've completed a FAFSA and or a CSS profile, they have a pretty good idea of your finances, and they do a complicated series of calculations to determine what they think you can afford. Now, I've never met a family who got their EFC calculations and said, oh yeah, that's about right. That's what we can afford to pay, no problem. It's more like, are you kidding me? This is what they think we can afford to pay? And the reason for that is from very often, particularly with middle income or upper middle income families, Your EFC calculations are highly inflated through no fault of your own. It's just the way you have your finances and your taxes and your business organized that can artificially inflate what they think you should pay. So it's really, really important to make sure that if you have any of those red flags on your profile, that you mitigate those problems before you ever submit a financial aid application. I'm going to give you an example of what that looks like in a minute. So the last thing I'll mention here is need. So need is defined as how much aid your family is eligible for. Let me give you an example. So let's say the cost of attendance at a university is $50,000 and you have been assessed to have an expected family contribution of $30,000. That's what they expect for you to bring out of your own pocket. That means you have need of $20,000. That's your demonstrated need. Are you going to get $20,000 worth of financial aid? Maybe, depending if you're applying to schools that are likely to be generous, but not necessarily. They don't guarantee that they're going to fill your need with money. But are you going to get more than $20,000? Certainly not. So the way it works is the lower your EFC, the higher your need. The higher your need, the more financial aid you're eligible for. So you want to be able to demonstrate as much need as possible, apply to generous schools so they fill that need with free money. Right? Does that make sense? Let's show an example of what I mean by this. So let's say you're looking at two schools, one public and one private. We know that private schools are more expensive, right? So let's say we're looking at a public school that has a $33,000 cost of attendance, and your EFC is estimated to be $33,000. They've assessed you and said, yeah, okay, you can pay full price here. Are you going to get any financial aid? No, you have zero need, you get zero aid. On the private side, however, it's a $70,000 a year school. Your need is $37,000. How do they meet that need? Well, maybe both schools are going to offer your student the student loan of $5,500 that they could choose to take. And at the private school, they're going to gift aid, that might be merit aid or it might be a grant or scholarship, $25,000, which is great, right? By the time you pay back that student loan, the true cost, you're going to pay full price at the public school and you're going to pay about $45,000 a year at the private school. It's still better than 70, right? But you're right, the private school is more expensive. But now let's see what happens when we take the inflation out of this family's expected family contribution. They've maneuvered their finances so that when they are assessed, they're assessed more favorably. So now they've got $13,000 of need at the public university, and $50,000 of demonstrated need at the private school. So at the public school, they're still, the government's still going to offer that student loan, but the public school might not have much money to give. Typically, they have less money to give at the public schools for a family that is in this range, right? The private school, however, fills that $50,000 worth of need with a $40,000 package of aid. Now, which school is more affordable? You might be surprised that that private school ends up being more affordable, less expensive than the public option. Not only that, but you have to take into account how long it will take your child to get their degree. Typically, private schools, a kid can get through in closer to 4 years. Public schools, because of their size, sometimes they're really impacted. It can be hard to get all your classes. Depending on the school, sometimes it takes kids longer to get their degree. So that can be an issue. And by the way, I have no stock whatsoever in pushing a private school over a public school. It makes no difference. There are great public schools. There are great private schools, right? I just want you to be able to see that your options may be broader than you initially thought. Okay, so what we really want to do is a college affordability analysis. And that looks not only at your income. It's not just how much money do you make. If it was, there'd be one question on the FAFSA. And clearly, there's a lot more information there, right? Looking at your assets, where you have your money stored. Do you have savings? Do you have investments, et cetera? How your taxes are organized. That's a really, really important way to find money for college. Big surprise there. Debt. Do you have debt? Do you have to go into debt? What's your debt structure like? We talked about your EFCs. And by the way, there can be multiple EFCs. The FAFSA will issue one figure. If you submit the CSS profile, different schools might assess you differently. So don't be surprised if you have more than one. Equity in your home or rental property or vacation home is an issue. The generosity of the kinds of schools that your child might be considering. Opportunity cost. This is really important because depending on your financial situation, you may have various options for where you've got your money and which monies you want to use to pay for college. So if you take money out of one particular account, say to pay for college, but there might be a cost to that decision that is unforeseen and you want to factor that in. That might be money that could have grown exponentially and paid for your retirement, something like that, right? You want to make sure that you use your money wisely and take into account your opportunity cost. Cash flow. This is something else that's really important, that you want to find as much cash flow as possible so that you can better pay for college and not have to borrow so much. Doing a cost benefit analysis, really weighing all of your options so that you understand how much it's going to cost you depending on what path you take, which financial forms are required of you. You want to make sure that you get everything that the school is requesting of you. Sometimes there are supplemental forms that you have to submit, and you want to make sure that you get those in. You don't want to give them any reason not to give you as much aid as you're eligible for. And then the final analysis, you want to make sure that you're protecting your retirement, that you're not damaging your long-term future in the process. You want to try to be able to balance them both. So the kinds of things that could impact those EFCs, that could cause them to be inflated, there's a myriad of different issues. I'm just giving you a smattering of them. Of course, your income, your assets. Hey, are there grandparents involved or a third party that has money that they want to help support your child? How have you been saving money? Do you have 529 plans or other savings vehicles like custodial accounts? UTMA, UGMA accounts, those types of things. Where you've got your cash and how much is there, what your expense load looks like. In addition, how your retirement is structured. If you own a business, how your taxes are structured, your property. In addition to all those things, there's also family dynamics that come into play. Is there a divorce or a non-custodial parent or a parent that's sort of MIA in the picture, right? Is there adoption or guardianship? If you maybe expect to see an inheritance at some point in the process of paying for college. All of these different things, if there are changes in your situation from year to year, that's going to impact your financial aid eligibility and your EFCs. So you really want to understand which things apply to you and how. So a couple of quick case studies. We're getting toward the end here. We're going to go a few minutes over. I hope that's okay. There's a lot of information here. But we were working with a family that had $100,000 saved for college in a particular kind of savings vehicle. It was costing them $20,000 worth of demonstrated need in their financial aid eligibility. And by restructuring that, where they were holding their assets, their savings, we were able to help reduce them that EFC and increase their eligibility for aid. Another family we worked with had a small business, and they just didn't have quite enough to cover both their kids, and they were going to run out of money. And so by looking at their business structure and their tax structure, we were able to help them open up cash flow that made it possible for them to see both of their kids all the way through college. And then in this situation, this is close to my heart. So this woman's a social worker, so her income was fairly low to begin with, and her husband passed away, and she inherited $600,000, which was going to be her nest egg. That's what she needed to retire on. But she had 2 kids, and that $600,000 was, going to be looked upon by the government and the schools as a way for her to pay for college. But she needed that money. She needed to protect those assets. We were able to help her restructure that so that when she went to submit financial aid forms, now she's eligible by the time she has 2 kids in college for 4 years each. That's $240,000 in aid eligibility that we were able to open up and protect her retirement. So I hope those just give you a sense of what I'm talking about and kind of give you a context. So ideally, we've all started saving money for college the minute we found out we were pregnant, right? Okay, so that doesn't really happen. We're not saving all these years because we have other obligations. But here's the thing. We specialize in what's called late stage college funding planning. The earlier you can begin, I mean, I wish you guys all had ninth and 10th graders, right? Because that would give you more time, more opportunity. The earlier you begin, the more options you have to impact your own outcome. And you just have more choices because of that prior year assessment. It doesn't mean that if you have an 11th grader or a 12th grader that you're on your own. It's even more important at that stage that you use what you do have in the smartest way possible so that you're not spending more than you have to. So we can help you. There are special benefits that you get as a member of the National Society of High School Scholars. All of you have coming to you a free professional college funding evaluation. You also have the opportunity to get on our platform, use the free software tools that are available, spend some time, explore what those are. And then if you have a situation where your finances are fairly complicated, there are discounts on our advanced services, and I'll show you what those are. Okay, so you may not need advanced services. Do not purchase anything from us on our website before you've spoken with an advisor and talk to them about whether or not that's even appropriate for you. Because very often we'll talk to folks and we'll say, no, you know what, you don't need this. Don't buy this. It's really only for those whose situations we can significantly help. So the way you access the platform, go to the webpage for high school scholars, and you'll see partners circled in red, and then click down where it says nonprofit and educational organizations, and you see us here, SMARTTRACK College Funding. Click on that, and that's going to give you the link to where you create your account. Don't just jump on Google and find SMARTTRACK and create your account from our public-facing website, because then you won't get the discounts and the resources available to you. So you want to make sure that you're coming through the society so that we can track you and know that you're a society family. So you click on that, take me to my my account, create my account. You would put in your email address and come up with a simple password for yourself. And you should know that we do not buy, sell, trade, share, barter your information, and your information is secure. We don't use or ask for any sensitive information, so social security numbers or account numbers, nothing like that. We want you to feel safe and secure knowing that you can use this platform and you're not going to get inundated with unwanted email or anything like that. So it's a really safe platform. So the first thing you're going to come to is a really user-friendly college funding assessment. This should take you about 5 minutes to complete. It's going to ask you some basic information about your household's finances and makeup. You don't have to give details here. We're really just looking for the generalities, so that the next thing you do after you take this 5-minute assessment is schedule your complimentary evaluation. So you're going to get a chance to speak on the phone with a professional licensed college funding advisor about your specific situation. I cannot stress to you how important this is and that you take advantage of this opportunity. So you can schedule the call right from the platform. When you talk to your advisor, it'll be over the phone or in an online meeting, and he or she will be able to help you evaluate where you are right now, see if there's some room for improvement. If you have financial questions, they can answer them. It's a really good way to kind of suss out where you are. It's really important that the assessment that you've taken, that 5-minute assessment, it's going to help make that conversation more substantive. The advisor will be able to review those numbers with you, ask a few more follow-up questions, and really give you some important information and really talk to you about your situation in that conversation that you're going to have with them. So it's really a 2-step process. Okay, so I told you that we do have advanced services for families that need them. This is what it entails. Remember those 3 takeaways I said, the 3 things that are really important for lowering your college costs? No surprise that we tackle those issues head on. So we have a tool called SMARTTRACK Advisor. That's where you meet one-on-one with your SMARTTRACK advisor to develop and implement a comprehensive plan to pay for college for all the kids in your family. That's where the advisor is going to help you determine what your best strategies are, what your options are for how to pay for college based on what you bring to the table. looking for things that are elevating your EFCs, making sure that we can maximize how much aid potential you have. That's all part of coming up with your plan. Those, by the way, that can be as many meetings as are necessary to develop and implement that plan. It might be 2 or 3 meetings, it might be 4 or 5 meetings. It just depends on the complexity of your particular situation. It's just the one price. And then we have something called Premium, and that's comprised of 3 software premium tools. The first two, Smart Navigator and Smart Scholarships, help you find those generous schools. Now, we're not going to tell you which schools to apply to. Your student needs to do that work and find which are the really great match schools, but then run them through the Navigator, and it's going to give you what we call a green, yellow, red analysis to make sure that you've at least got some schools on your child's list that are likely to be generous based on historical giving. So that's really important. And then secondly, scholarships give you merit awards that are available from every school in the country. I think there's 15,000 merit scholarships in this online tool. You can look up the schools you're looking at that your child's applying to and make sure that you're not missing any opportunities to apply for merit aid. Remember, that's free money. You don't have to pay it back, and it's not attached to your financial need. And then the last piece is called Smart Steps. This is a resource that is full of tutorials, videos that can help you avoid the common missteps that families make when it comes time to submit their financial aid forms. So Advisor is great as early as possible, whether you've got a 9th, 10th, 11th grader, even if you've got a 12th grader, somebody who's just graduating high school, have that Advisor now. Navigator and scholarships are really good in that junior year or senior year when you're starting to really develop your college list, and Smart Steps you'll use come senior year when you're actually applying for financial aid. Taken together, the retail cost of all of this is $991, but through the society, you all have access to this package for $696. That's all in one flat fee. There's nothing additional, no upsell, nothing like that. And by the way, depending on your situation, Advisor might be appropriate for you a la carte, or the premium services are also available a la carte. So I'm just giving you the price for the total package that is most appropriate for most people, but you might break it up depending on your needs. Okay, so here are the steps that you need to take. Follow that link for SMARTTRACK that I showed you. It's available on the Society website. Create your account, take that online assessment, and schedule your evaluation. That's really going to be crucial for you to lower your costs. It's the first step that you need to take. Discuss your situation and find out if you have red flags, find out what things you can be doing to help lower your costs overall. Oftentimes in these conversations, by the way, the advisor will give you some suggestions, maybe questions to ask your accountant, things that you can do. Some families need a lot of work. Some families just need to say, hey, you know what? If you just do A and B, you're going to be in good shape. So this really is going to be a useful, helpful call, and you can expect that evaluation phone call to last, 15, 20 minutes. So I hope I've described what that is. And again, it's completely free. There's no obligation. There's no cost. It's yours as a member family of the society. So right now, I've finally come to the end of the presentation, but you're not done yet. Grace, if you would please launch the poll. So it would be really helpful, all of you, to just answer a couple of really quick questions for us so we get some feedback. I hope that this was helpful, that you learned something. I know that it's like drinking from a fire hose. There's so much information. You will get a link if you want to review any of this video, if you want to share it with a partner or another family member, you have the opportunity to do that as well. And then we can open it up for questions. So I'll hang around. Hang on just a second. Let me get back to the screen here. Hi there. You guys, thank you so much for taking the time. I hope, again, that it was helpful. Let's see what some of the questions are. I'll hang around. We're not going to close this until everybody's finished with the poll, too. So just to let you know that. Okay. So I see some questions here, and I don't know, Grace, maybe you could turn on your mic and let me know if these were questions that had come in before I'd answered them, or if I can still answer them. Let me see where the questions are. Oops. Okay. Sorry, guys. I'm going to go back to the moderated chat here and find out. Grace, are you available to pose the question so I can see which ones? When do you start applying to colleges? That's when your child is in fall of senior year, but all that planning happens in the years before. Active duty service members, you have a lot of aid that is available to you through veterans programs and the financial aid calculus. I don't know personally. I'm not the expert on that, so I don't want to attempt to answer that question. But you certainly have resources available to you as a family in the military. So some of you are asking specific questions about your situation. You're divorced and you don't want your ex. Oh, this is a good question, actually. We see this a lot, where you want to talk about your financials, but you don't want to share that financial information with your former spouse or partner. We work with that all the time. So each of you can work individually with the advisor on behalf of the student. It doesn't mean you're paying twice, but sometimes we have to go to both parents independently to gather the information that's necessary, and we certainly protect your privacy. So that's important, I know. So you begin applying for financial aid again. The fall, October, begins October 1st of your child's senior year in high school. That's when you begin applying for financial aid. That's when that window opens, both for the FAFSA and the CSS profile. But again, you want to organize your finances in the years before so that when it actually comes time to submit those applications, you're putting your best foot forward and you have all your ducks in a row. Oh my goodness, there's a lot of questions coming, so bear with me, okay? Right. So someone's asking about some ways that assets and funds can be sheltered. That's an excellent question for you to talk about with your advisor when you get on the phone for that evaluation appointment. So specific questions about your situation and what might be good options for you, that's the perfect place to ask those questions. So for a 2021 graduate, the year's taxes that they will look at for the FAFSA would be 2019. So you're applying for financial aid. You submit your FAFSA in 2020. The fall of 2020 is when your senior is beginning their senior year is 2020. They don't graduate until 2021, but you're applying in 2020 and they're looking at your 2019 taxes because that's a full year that you would have already completed your tax return, presumably, right? It's the nearest full year of taxes. So I hope that makes sense in terms of prior year. Your student doesn't graduate until 2021, that following year, but in 2020, when it's the fall, they're looking at your 2019 taxes. I hope that makes sense. You can begin looking at scholarships as early as possible. Some private scholarships have different criteria. Some are open to 9th and 10th graders. Some are open only for 11th graders or 12th graders. It just depends. But what happens is when you do win a private scholarship, that money is typically held and then paid directly to the university where your child ultimately enrolls. You don't get that money in your own pocket until or ever actually. That money typically goes directly to the school to pay tuition. So Grace is telling me I should look at the public ones. Let's see. Hang on, I'm reading. Right. So I have a question about how we're talking about artificial inflation. pass-through entity income, et cetera. Those are, again, the perfect kind of questions that you're going to want to ask your advisor. They're going to be really well equipped to discuss those issues with you. If you have a rising senior, is there still time? So yeah, so you can still maneuver your finances. You have perhaps fewer options than if you started earlier, but that doesn't mean you don't have options. And the thing is, because you have to apply every year for financial aid, you have to resubmit that FAFSA when your child is a sophomore and a junior, and again for a senior. And so financial things that you do now, it might not help you the first year, but it might help you the second year and the third year. The idea is to shave your overall costs significantly over time. So hopefully that helped. All right, was this helpful? I hope so. Have we got people filling out the questionnaire? I hope so. Let me see if I can take a few more of these questions. Right. So if you pay for the premium service, does it work for all of your children, even if you need help over 3 or 4 years? That's a really good question. So the way it works is that the advisor, that's where you're working on developing a plan to pay for college for all your children. That's a one-time plan. You can always go back and, if your situation's changed, you can get back in touch with your advisor and discuss those. The premium resources in terms of the navigator and the STEPS tools, those change year to year and get updated, and they're really designed to be used per student. So those particular tools you may need to re-up for your students down the road if they want to be able to use the navigator tool. If it was helpful in your first year or with your first child and you want to use it for your second or third child, they'll need their own copy, and that's applicable for their own year. But the coming up with the plan is designed to cover all the kids. You don't do that more than once. Is it still possible to get full scholarships? How do you do that? So, if you have an EFC of 0, meaning based on your financial situation, you are not expected to cover any of your costs because you're low income. Again, you want to be looking at some generous schools. The government will help come to your aid. They may provide some grants and scholarships that we discussed. They may provide some loans. That may or may not be part of the picture. A full ride scholarship, we see that sometimes that people with athletes are thinking, well, maybe I'm going to get a full ride from my athlete. Unfortunately, very, very few athletes get a full ride scholarship. So it's really important, again, for anybody under any circumstances, just to review their situation, make sure that all of these things are handled. If there's anything at all, sometimes we find that families miss out on financial aid by inches, not by miles. In California, we've seen a family where they had just enough in their savings account that it put them over eligibility for a California state grant. Their income was low enough that they were going to qualify, but they didn't realize that they had just enough in their savings to disqualify them. You don't want to disqualify yourself for any financial aid like that. So it's important to have these conversations in advance and make sure that you've got everything situated appropriately. I hope that makes sense. Bear with me, folks, as I'm looking at the questions. Again, if you're thinking about specific options for your situation, ask your advisor when you have your complimentary college funding evaluation. The other thing I just want to say again is that you really want to make sure that you take advantage of this opportunity to talk to somebody now. Don't put it off. I see over and over and over again where people are super excited. They really want to take advantage of this. It's really going to help them. And then life gets in the way and they get busy or they put their head in the sand because, oh my gosh, I don't want to think about my finances. And then they wake up and their kid's a senior and they didn't do it. And they're thinking, oh my goodness, I really blew it. I wish I had done this sooner. Don't do that to yourself. You're going to regret it. Take advantage, strike while the iron's hot, make your account, take that quick assessment, schedule your appointment, you have absolutely nothing to lose, and it's really going to help you a lot. And I want to see you take advantage of the opportunities that are in front of you. I see someone's asking me a question about moms, a single mom and single mom's income, but I can't see all of the question. Oh, there it is. Right. So I think this is a question from a student. You have a single mom, and are you more likely to get more financial aid because you have a one-income household? Depends on what that income is and what the rest of her financial situation looks like. So it's impossible to say. And by the way, the $991 SMARTTRACK Pro package bundle doesn't cost you $991 as a society member family. Remember, you get the discounted rate if in fact it's even appropriate in your situation. So that discounted rate is $697. I see someone here said $991, and I want to make sure you know that's not what it costs you because of your association with the society. Um, and I see another question about FAFSA forms and if the student resides with one parent but taxes are filed with another. Again, it's going to depend on your situation at the time you're submitting the FAFSA. That's a great question to ask during your evaluation appointment and find out about specifics based on your situation. Okay, I'm going to take two more quick questions. So I see a person asking about the GI Bill covering a portion of. Hang on one second. You live in Virginia and our son wants to go to Lafayette in Pennsylvania with a high cost of attendance. The GI Bill will cover part of it. How will that factor into your EFC, and does it hurt us? No, I don't think it hurts you. There might be other things that may or may not hurt you. The fact that you do have money coming in from the GI Bill, that's great. Let's see what else there is. Sometimes we see folks that are really excited because they know that they're going to get a grant of something, a couple. Maybe it's $20,000, but in reality, they could have qualified for $30,000 and they just didn't know it, right? So there might be other ways that could save you money in addition to what you could get from, say, the GI Bill. Are parent loans subsidized or interest from day one? Typically, those parent loans, you pay interest from day one. Do disabled vets have additional benefits? Again, I don't know the details of the veterans' benefits under the federal financial aid situation, but I believe there are certainly benefits for disabled vets, but I'm afraid that I can't give you specifics on that. Can you start a FAFSA application earlier than October 1? No, not for that coming year. So if your child is going to enter their senior year in 2020, October 1st of 2020 will be when you are first eligible to submit a FAFSA. That's when the government opens up the application. You can't have access to it before then. If you've got a child who's already graduated and is going to go to college in the fall, and you can submit the FAFSA for the previous year, I think they're, sort of late to the party stuff you can do, but for the following year to start in 2021, that application will open in October of 2020. I hope that makes sense. It was helpful. Thank you. I'm so glad. I hope it was really useful and that you sleep easier tonight. I know that once I started on this road, I slept a lot more peacefully. And you know what? When your kids are in high school and they're starting to go through the college planning process, it can be really stressful. There are a lot of things going on. The fact that your kids are members of the society and have all of the support that the society provides is fantastic. And I applaud you for doing that because I think it's really helpful. But even within your own household, it can be stressful. Your kids are under a lot of stress, and so are you. And when you can take care of your finances and determine what you're going to do and how you're going to do it, it really just helps diminish overall. So I hope that this is the first step for you in that process. Um, okay, so that's it. It's already pretty late. We've gone well over our time. So again, thank you all so much, and best of luck to you and your families and your students, and the best for your health and well-being. All right, guys, take care.